Carl and Sarah, thank you very much, and welcome to the Halftime Report. I am Frank Holland in for Scott Wapner. Front and center this hour, the fate of the record rallies. We head into the final stretch of this year. Our investment committee is standing by with how they are positioned into the year end. Joining me for the hour, we have Joe Terranova, Steve Weiss, Shannon Sakosha, and Sarat Sethi. But first, we take a quick check of the markets right now. Taking a look, all three indices in the red right now. The Dow back fractionally, the S&P down 0.5% as the Nasdaq, the hardest hit, down more than 1%. And really, that's where we need to begin. Joe Terranova, I'm going to start off with you. What do you think is leading the markets lower? We did see the markets take a slide to the downside following PCE, but it's important to know PCE was in line. And if you look at important data points in that report, things like personal income, that was actually much better than expectations. So what do you think is moving the markets lower right now?
Yeah, Frank, and the reaction in the Treasury market was not troubling at all. You've got a 10-year Treasury yield that's back towards 4.25. It's down 6 basis points. So let's not blame it on any type of economic condition or an expectation as it relates to what the Federal Reserve is going to be doing with the pace of rate cuts in 2025. Today is all about technology. That's the problem. If you look at the S&P 500, 61% of the stocks in the S&P 500 are actually higher today. Here's the problem, though. If you look at technology, 88% of the stocks in the S&P 500 are lower today. Now, in the past several weeks, we've been able to avoid a day like today where technology really drags the entire complex down, because if semiconductors were weak, you found strength in software. Today's that's not the case. You have semiconductors down. You have hardware down. You have software down. If I look right now, 92% of software companies, 27 software companies in the S&P are down today. 90% of semiconductor companies, there's 20 of them in the S&P, they're down today. So that's clearly the problem right now. I don't think it's something onerous overall for investors to think about as we move into 2025, but certainly the index is going to struggle if you lose the entirety of the technology sector.
Shannon, agree, disagree with Joe's take? Do you believe that PCE was a factor at all? Again, important to note, it was in line, and a number of metrics in there were actually very strong.
Yeah, I think our view overall, Frank, and thanks again for having me, is, around, what the Fed will do is really going to take a focus more on fiscal policy than monetary policy in 2025. And so our view is that PCE is not really driving this. I think the challenge that Joe just articulated, I want to take that a step further. And, there's been this talk about this vulnerability of valuations in the tech space, and also this compression of the delta between earnings growth of the top 7 or 10 names and the rest of the S&P 500. And I think what you're seeing is that we're at the end of earnings season, right? We're not able to see the manifestation, the realization of that continued earnings growth until kind of the next couple of quarters. And so I do think you're going to see some of these days, Frank, where we're sort of seeking or searching for a rationale for the sell-off in tech that goes beyond just valuations, because frankly, they haven't been a deterrent thus far in great measure. But I do think that what we're really looking for is this confluence of stronger earnings growth in these sectors, this pro-business foundation that's going to be brought in from Trump 2.0 administration. But we would be naive to think that if there are questions about demand, or if there is question that these earnings could compress further based on weaker guidance going into 2025, I think we would be naive not to anticipate that we could have some of these days where the tech sector and its concentration just proves to be too much to rally the market, and even if we have some strength outside of it.
Yes, Rob, I'm going to come over to you right now. Speaking of valuation, though, if valuation is at all a factor, you got to keep in mind the small caps. They're trading at about 29 times compared to the S&P trading about 23 times forward earnings, and small caps are actually up today, Sarat.
So I'll take that, but I want to go back to the tech sector also. Frank, one of the things that you're seeing is the tailwind behind financials, and small caps as a whole have a lot of financials behind them as well. So you've got that positive sector rotation into financials, which contains so much of the small cap. So you're seeing that movement of money going in there. With regard to technology, Frank, you had a couple key earnings yesterday, and they were Dell, Autodesk, Workday, and all of them, did not hit the expectations that investors wanted. That caused a bit of a sell-off in the software names, as Joe had mentioned. So you bring that, and if semis are down, software is down. You're seeing selling across the software sector, whether it's Oracle or Salesforce, and I think that's bringing down some of the tech sector and probably some rotating out of there just because expectations were so high, and the sales cycles for a lot of these companies, there's the embedded AI in all of them too. So I think you have to be careful as to what the future is. I still like that space a lot, and I think the opportunity there is going to be much better now.
So right, you're not the only person that likes that space a lot. A number of notes out about tech today. Evercore SI out with one, talking about the triple Q, saying in part, it's too premature to put the succession plan in place, basically saying that they believe tech's going to continue to have leadership, saying that, Apple's on the verge of a breakout, Microsoft's flat for months as software eats semis, Amazon and Tesla are leading the quote-unquote consumer charge. They also look at Meta, just being Meta, up more than 60% year to date. And then look at Google on support in the 200-day moving average. Weiss, I'm going to come over to you. Obviously, tech's under a bit of pressure today, but do you believe from now, at least till year end, does it resume leadership?
It's never that simple, Frank, as you know. And if you listen to what Joe said and the others, Shannon and Sarat, all have valid viewpoints. Put those together, and I'll add something to that as well. Yes, I believe tech is a source of funds. Between the algos driving the market as well as momentum players driving the market, momentum in the big cap players, despite reaching new highs overall in the Qs, has pretty much died. And then you add in the announcement, we'll talk about it later, that we got from Dell, and then demand gets pulled into question. Like, is there demand? And demand apparently is a couple of quarters off. And then what's going to happen with tariffs? So I take a look at Taiwan Semi, for example. I mean, that's come off of their highs of $200, meaningfully off. And even though Taiwan's not part of the dialogue on tariffs, you still have to wonder about how that's going to play out. So right now, you're still transitioning from all the news being great news for tech for most of the last couple of years to, hey, maybe I got to find someplace else. This has been a great source of profits. Valuation's actually not particularly excessive in these, but nonetheless, they are the piggy bank for funding the rest of the market. So I do think it'll be in a leadership position. The fundamentals will remain strong. I can't tell you it's going to be through the end of the year or it's going to be into next year. And then I take a look, actually, at the Deeres and the Cats and those kind of names, and I look at valuation as not being supported by the fundamentals, particularly with rates where they are. And rates are the most interesting thing to me because the 10 years has been coming down after having a nice move up. And that is supporting those valuations for now, but you still have high real rates. And what's that going to do to the market? I do think that's at play today.
Weiss, you mentioned tariffs. Obviously, the president-elect out with an announcement the night before yesterday, but yesterday we closed at records for the S&P and the Dow. It seems like the markets just kind of shrugged it off. And the J.P. Morgan note today where they gave out their 2025 price target, there was a line. If you go deeper in there, they would look at tariffs. Shannon, I'm going to start with you on this one, if you don't mind. They say in part the negative S&P 500 EPS impact from a 60% tariff on all Chinese imports. Important to note, 60% was not announced. It could be as much as $15, and just to put that in context, their full year is $270. And they continue to say it's worth remembering that the more consumer-facing tariffs were not imposed at all during the Trump 1.0, the first term, and any broad-based escalation in goods under these tariffs could possibly have a noticeably larger impact than previously. Agree with that take? Is it possible on this low-volume day that people are starting to maybe even think about the potential impact of these tariffs?
Well, I think a good note would be to go back and look in the Trump administration about how many tweets were sent and how many tweets were sent around tariffs. I think there were almost 900 tweets that were sent around tariffs. So I think we should steel ourselves for continued commentary coming via this type of platform. I think the important point here, though, is that if we are looking at some of those consumer-facing tariffs,
sure.
Even with the tariffs that were put into place, it's estimated that American consumers digested 80 to 100% of those price increases back in Trump 1.0. So, and you think about the dynamic environment we have now, Frank, we don't have as much pricing power. And so it would be, foreseeable that you could see that consumer impact, particularly if it's on goods. I would say the other thing to really think about is that we've been experiencing goods deflation over the last year and a half or so, which has really helped the Fed get closer to its target because we haven't seen that same easing on the services side, particularly in areas like insurance. So there are a lot of ripple effects as it relates to these tariffs, but I think, until something's written in and that we get to the point where we're actually feeling like this is close to true implementation, I think it is going to be difficult at the industry level to be able to select those areas. However, if you look across the broad landscape, there are parts of the investable universe that are potentially more vulnerable, and investors should start to include that in their calculus as we move into 25.
Yeah, speaking of that, Soraya, I'm going to come over to you. When we look at the earnings estimates for Q4 in 2025, I mean, they're considerably lower than they were just a few weeks ago. If you go back to October 1st, looking at Q4 back on October 1st, it was 13%. Today it's at 10%. Q1 of 2025, it was over 14%. Now it's just under 13%. How do you view these revisions when it comes to EPS estimates? But at the same time, we're seeing such bullish calls. Again, I just mentioned JP Morgan's call for the S&P next year, 6,500. I'm just looking down the list. Morgan Stanley at 6,500. Goldman at 6,500, UBS at 6,600.
So I think, Frank, part of the equation there is the earnings growth is really going to come from the large cap. And that's what people are betting on, especially the strategists. So I think if you don't see that and you see disappointments, that could bring the market down. But the big boys, if they do perform, will keep riding the market. But again, I think the opportunity is going to be a lot more on the other 493, especially when they have earnings growth on some of the others. So expectations are high. There's no question. Again, I'm going to refer to last night. If you underperform, you're going to get a sell-off. And I think that's where the key is going to be going forward for the next couple of quarters.
Joe, coming over to you. I mean, when we look ahead right now, I know we just talked about weakness in tech right now. I talked to you about the other note from Evercore. They believe that tech's going to continue to have leadership. But should we start looking at these estimates when it comes to earnings and maybe starting to factor in? I know it's only a proposal when it comes to tariffs, but the idea that they may be inflationary, that they could hurt the consumer, things like that.
Well, look, in the first administration, I think Shannon mentioned this, they were not inflationary. Most of the tariffs that were implemented were applied to capital and intermediate goods. And I heard before a 60% figure for China. We don't know if we're going to get to that extreme level. Currently, the aggregate weighted tariff on China is 12%. So that's a big leap to take. Also thinking about tariffs, let's understand something. A lot of what gets lost in the message of the market sometimes is the way people are positioned and sentiment. So I go back to how we're trading today, and I point directly at positioning itself, because if you want to pinpoint tariffs towards a technology sell-off, all right, I understand that with semiconductors, but it doesn't apply with software. Software is relatively immune to tariffs. Look at the Mag 7. The entire Mag 7 are down today. So I think it's more positioning than anything else, and I think it goes back to the conversation that's been front and center over the last week, which is it finally time for these equal-weighted strategies to outperform? We've seen strength in financials. We've seen strength in industrials. We've seen broadening out. You've got healthcare today that seems as though it looks as if it wants to awaken. And I think when you turn the calendar to 2025, that's the important thing for you to think about. What other places can I go to that is not technology? Because we're not in a 2023 world where you're going to have to concentrate directly towards semiconductors and the Mag 7. It's a much better environment, a more compelling environment for investors, and I think that's the critical question.
You know, Joe, to your point, if you look at the S&P equal weight versus the market cap weighted index, the S&P equal weight actually outperforming the regular S&P, let's just call it that, by 1% since the election. So we are continuing to see that broadening out. All right, time now for our chart of the day. Dell shares, they are tumbling on earnings. Let's get to our Christina Partsinevelos with much more on what's driving that big move to the downside. Christina.
Thank you, Frank. Well, Dell's getting squeezed by the AI chip waiting game, forcing the server giant to lower revenue estimates. Sure, the delayed PC upgrade cycle did play a part, as we saw with HPQ as well, but there's another critical factor. their heavy reliance on NVIDIA chips. During yesterday's earnings call, management revealed that AI demand was, quote, shifting to Blackwell. That's NVIDIA's latest GPU chip iteration. Their AI server pipeline may have jumped 50% quarter over quarter, but Dell can't convert that order book to finished and shippable products until it gets NVIDIA GPUs, the latest ones. They had to slash their full year guidance as well, and that's exactly when you saw the stock take a nosedive from about negative 4% to down 10%, leading to the negative sell-off today. Management, though, was candid about the, quote, unpredictability of AI server demand, something Supermicro also reiterated. Supermicro's CEO on their earnings call saying, quote, we're asking NVIDIA every day. We have a very strong offering waiting for the chip, so we need NVIDIA's quick support. With NVIDIA's annual product cycle creating this predictable pattern, we might be looking at a new normal, an annual digestion period that I'm calling for big tech customers. And Micron could actually be next. Jordan Klein from Mizuho tells me that he sees some risk for earnings if it takes 1 to 2 more quarters to ramp Blackwell volumes enough to drive that memory upside. The message, though, is clear. Waiting on NVIDIA can, hurt your bottom line and definitely share price in the near term. Frank?
Christina Partsinevelos, thank you very much. You have a great Thanksgiving.
You too. Thanks.
Time now to bring in Dell shareholder and halftime committee member Bill Baruch on the phone. Bill, I know you're traveling for Thanksgiving. That's why you're not with us by video right now. But I just want to get your take on the quarter. What did you make of not only what Christina had to say, but what you saw on the earnings call, the numbers themselves, and some of the misses in some key areas?
Yeah, I would reiterate what Christina said. The AI server sales for quarter four, fall short of expectations, and it's just really a timing issue with the Blackwell GPU and component availability. Overall, though, we're also focused on the PC refresh cycle, and that was disappointed. The outlook there was worse than expected, and we were thinking that people have been saying one of these quarters it's going to bottom out, and again, it still hasn't. We didn't see that from HP earnings either. So that was our fear. The PC division remains weak and drags on AI and server momentum. Overall, though, AI PCs likely won't drive the growth until 2026. And I think that reiterates, again, what Christina was saying and how I started talking off. But I think that just kind of pushes out expectations. For us, though, this is a seed that we've planted. And if you take a step back, from the August lows, the stock has rallied nearly 70%. It's a big move, so it's given up a little bit here today. I'd like to see it hold in above 115 over the coming weeks, and we may look to add a little bit to it.
All right, so you may look to add a little bit to it. I also want to come back to one thing that you said, that the PC refresh cycle is going to come in 2026. I got to be honest with you, Bill. I had someone from Dell on my show, earlier this year. They said the PC refresh cycle is going to start in 2025. And I remember back in 2023, people said the PC refresh cycle is going to start in 2024. This cycle seems to continue to get pushed out. Why do you have so much confidence now in 2026?
Well, I think that we can start seeing it in 2025. It's really the factor of driving the revenue growth. Where is it going to make a difference from the expectation? Remember, a lot of these tech names, it's not what you're doing for me now. It's what are you going to do for me in the future. So you need to see that some of that revenue growth is already priced in. I'd like to see it really pick up. So I think we see an impact in 2025, but the growth is really going to take place in 2026.
All right. Bill Baruch, Dell Technologies shareholder, saying he's going to think about buying a little bit more. Bill, great to see you. Have a great Thanksgiving.
Thank you.
All right, let's hit some earnings movers. Let's start off with CrowdStrike. Those shares are lower right now. Joe, I'm going to come over to you. What do you make of the report that we saw? Obviously, CrowdStrike at the center of that big IT issue that crashed just about everything in the world just a few months ago. But what do you make of this quarter that we just saw?
Well, it's the second report since the July 19th incident. And the last report gave a reason for investors to be optimistic that there was a strong recovery underway. This report, you had less evidence that recovery is gaining further momentum. I don't believe it defeats the larger technical recovery that CrowdStrike has had since the August 5th low at $200. I still think it's within reach of the all-time high at $398, and there's enough there. So I'm not going to look at a EPS miss that's off by 2 cents and get discouraged enough to sell out of the position. I still think cybersecurity is the right place to be. There's 3 names right now leading the cybersecurity investment theme. Obviously, it's CrowdStrike, it's Palo Alto, and it's also Fortinet. So I think that theme is still intact, but I understand the reason for the pullback today. 2 conditions: earnings miss, and then an overall tech environment, which is obviously not a good one.
Yeah, not a great tech environment right now. By the way, let's go back to that 4-year chart. You can see literally when that July 19th incident happened, the big dip, and also the recovery. Shannon, I'm going to come over to you. I just want to get your take on the cyber trade overall. Also, by the way, next week we have Zscaler reporting and also Okta reporting. These were two companies that were supposed to be beneficiaries of that IT issue with CrowdStrike. A lot of talk about business moving over to them.
Yeah, I mean, I think this is a case where, there's obviously going to be some fundamental pros and cons for each of these companies. But Frank, if you remember, before AI was thrust on the scene, cyber was really the area where we felt that there would be sort of this increasing total addressable market across industries and sectors, right? So really a benefit and frankly, a risk mitigant for companies sort of across the cap spectrum and throughout different industries. And so I think it's more about, just some of the focus, the hype has been lost around cyber. We had obviously the disruption with CrowdStrike, which made it clear how deeply embedded this type of tool is in larger companies. But I think even small businesses really require this protection in order to alleviate this risk in their business. So I look at it more from a longer term trend. I think that there's going to continue to be growing allocation from a capital perspective to cyber. And it's really going to be, at this point, you don't have just one or two companies. Consolidation will come with time, but there are a number of ways, to Joe's point, to play this, whether you're looking at it from a fundamental or technical perspective.
Shannon, I want to ask you, why do you think that just budgets are going to start going towards there? I don't know if you remember, but last year there was new SEC regulations that mandated just better cybersecurity reporting, better cybersecurity plans. Why haven't we seen that play out in the sector in a more prominent way?
Well, I think it needs to be less regulatory driven, Frank, and more really about, looking at the sustainability of your business. I think that as we look at insurance providers, for instance, for companies, they're going to continue to be focused on what are your cyber protections, because there's often fairly significant payouts that result as a result of data breaches. And so I think it's less on the regulatory side and more as a business practice and the potential for financial loss. And I think that's really going to be pushed in part over time by the insurance side of the equation.
Right. Also looking at the BUG cybersecurity ETF, only up about 14% year to date, obviously lagging the other major indices. We're going to move on to Workday. Those shares also under some pressure on earnings, guidance lighter than expected. And Sarad, you actually say you're going to buy on today's pullback.
I am, Frank. And if you look at the numbers, they brought down their growth rate from 15 to 14%. And that really was a function of two really large customers that will close, but not in the quarter that they expected. Additionally, what I like about this is their margins are 26%, and they expect to go up to 30%. So you've got efficiency in a company that's still growing. It brought down its expectations just a little bit, but the demand for their products is so large. They're growing overseas. International demand is really big. I think the opportunity here, the stock's trading at 20 times cash flow. It's really a valuation we haven't seen in a long time. And I think, again, expectations because of AI were so far ahead of itself. The opportunity to buy more of this at this price, or even to get new clients into the stock, I think is really opportune at this time.
Sarad, very quickly, do you kind of believe the narrative that the CEO is kind of putting forward that the Department of Government Efficiency, led by Elon Musk, is going to be a tailwind for their business? His thought is that the government's going to move more of their loads from on-premise into the cloud. That's going to be part of this efficiency effort, and that's going to be a big tailwind for them. Is that a story that you're buying?
I wouldn't say that's my thesis. I think, that would be icing on the cake, and that would be a great opportunity for the company. But it's really the global demand, the customers moving more towards their software where they can realize how efficient it is and really how productive it is. It's a product that you can use to grow revenue. And I think that's really important in the software space as opposed to just cutting costs.
All right, Weiss, coming over to you. I mean, we're talking about a bunch of different areas of software, cybersecurity, HR software, ERP software when it comes to Workday. What's your take of just the sector right now? We've seen a software rally in recent days, but again, under some pressure today. And then we're seeing a couple of notable companies lower their guidance.
Well, first of all, let's talk about cyber. The facts of the following being involved with cyber companies on the private side is that the Biden administration held us back from using our full cyber capabilities to combat the capabilities of the big four. So Trump's not going to do that. Trump's going to unleash it as he should. So I think you'll see more opportunity in cyber going forward across across the spectrum, but particularly with defense companies like a Leidos, for example, or a Booz Allen as well. In terms of software, yeah, software is just a great sector to be in if the valuation is right, and it's not always right in terms of being more of a value, because they have recurring revenue streams, and those do deserve a premium. So unlike other companies where you wake up every day wondering where your order book's going to come from, software companies do that as an extent too. Their recurring orders are 80 to 130%. You get more than 100% because there's upselling as well. So I like the software space. It is driven somewhat by sentiment, and that's what we've seen, but I think it'll be back.
You know, Weiss, to your point about valuation, I'm looking at the IGV ETF, one that's obviously very closely tracked. P/E ratio of 66 times forward earnings. All right, coming up, the state of retail as the holiday season kicks into high gear. We will debate the best ways to play it. What's coming up next? Halftime's back in just 2 minutes. And we are back on the Halftime Report. Retail is tracking for its best month since February as the holiday shopping season is ramping up. Our Courtney Reagan joins us now as we kick off a critical stretch for that retail trade. Courtney.
Hi, Frank. Yeah, no rest for the retail weary, easy for me to say. We're moving from big earnings to the big five. So the unofficial start to the holiday shopping season begins tomorrow, online usually for the major retailers, even though many have already started these early cyber deals in October or even so far earlier this month in November. It is the most critical week of the year for retail. The consumer discretionary ETF, the XLY, has been positive 5 out of 6 Thanksgiving weeks since 2019, including 2024 week-to-date performance. Now, 2021, that was the only year where Thanksgiving week was negative for the XLY. You might remember we had a big COVID variant scare that week. Now, Deloitte says that spending during the stretch between Thanksgiving and Cyber Monday will hit a new record high, $650 per person. That's up 15% from last year. And that means 56% of total holiday budgets will be spent over retail's big five. Interestingly, all household income groups plan to spend more than last year during this stretch. And this weekend is a critical one for most retailers, but traditional department stores and big box stores really rely on it. It's a big week for Macy's in many ways. It's brand equity tied to the parade as the kickoff to the season. Shares are up 4.5% this week after its preliminary earnings report, but down about 20% year to date. And Target really needs a jolt of cheer after its disappointing quarter. Maybe it's Black Friday and Cyber Monday sales will do it. Oppenheimer, for one, thinks it's better positioned into the holiday than the market's giving it credit for. Shares down 14% month to date. Frank?
All right, Courtney, our Courtney Reagan, thank you very much, and you have a great Thanksgiving, Courtney.
Thanks, you
Good to see you. All right, let's broaden out this conversation. Weiss, I'm going to come over to you first. What did you make of what Courtney had to say, just the importance of these next 5 days when it comes to the holiday season, and how are you seeing the state of the consumer?
Yeah, I mean, look, you're in a very critical time, the most critical time of the year for retailers between now, the next 5 days, of course, because you're buying for Christmas, but going into the Christmas holiday. It's pretty mixed overall, as we saw from the numbers that came out today. Consumers in pretty good shape and willing to spend. So you hear from retailers that miss, and they will blame the economy. But it's funny, the ones that really do well aren't blaming the economy. So to me, it's really about how you execute on the retail side. We saw repeated poor execution from Target. And it's how you're positioned for the holiday in terms of trends and in terms of inventory. So I'm bullish on the consumer, and I think it's going to be a good holiday season. But again, you got to pick the right retailers to invest in. Who would have thought the Gap stores would continue to outperform? You know, conversely, who would have looked for Best Buy to provide some light guidance? So it's feast or famine in the sector, but consumer all is in good shape.
Yeah, absolutely. I mean, Weiss, to your point, as you mentioned, Best Buy cut their annual profit and sales forecast, saying holiday demand is going to be tepid. You saw Nordstrom actually raise its full-year sales guidance. So it really depends on which retailer we're talking about. Shannon, I'm going to come over to you. What do you make of this, the state of the consumer? Again, Courtney saying these next 5 days are critical for the holiday shopping season.
Yeah, I mean, I think the caveat here is, you know, that it's been off-cited over the last couple of days. You know, the consumer's going to spend more this year. Well, of course they're going to spend more this year in nominal dollars because everything costs more money. You know, I think you want to kind of take that apart. I think the challenge for retailers the last few holiday seasons, Frank, has been knowing really where the consumer is most interested. And so, like, we've seen volatility, for instance, in apparel prices over the last couple of CPI reports. Best Buy with the light guidance. Maybe people aren't buying large-scale electronics and they're more focused on, personal consumer electronics. And so maybe that bodes well for an Apple. I think what's really going to come down to is that, we've got one less week of shopping, but to whether that one less week of shopping is really impactful depends on how much is really in this next 5 days. And so I think we'll get a lot of great data from the retailers midweek next week. Our view is that we are seeing a little bit of an uptick in consumer confidence. We're seeing an improving consumer situation, but I think it really comes down to, where the demand is. And I think that's why you're seeing some of this tepid guidance, because demand may be, once again, surprising some of these retailers as we move into this holiday season.
By the way, Courtney had her own data. Deloitte out, Joe, I'm going to come over to you. Deloitte out with its Black Friday to Cyber Monday spending forecast. They say half of people are going to buy things for themselves. The average spend is going to be about $280. So a lot of people also buying for themselves. That might actually influence which retailers are doing better or worse. You have a lot of retail ownership: Walmart, Deckers, Ross, Costco, etc. What's your take on these next 5 days and just the state of the consumer overall?
Well, I think Stephen's right. I think it's about execution. And I think when you look at investing in retail, there has to be something thematic that you're getting behind. So you mentioned a few names. Here's some themes that I believe have tailwinds behind it. First of all, scale. Scale matters in retail, and it's reflected in the positioning that the JOTI ETF has in Walmart and Costco. They've also taken market share from Target, and we witnessed how Target has been punished for that in their most recent report. Secondarily, e-commerce. I think e-commerce right now is a very powerful tailwind behind it. The holdings we have there: Amazon, Coupang, which is South Korea e-commerce, and Mercado Libre. And then I think the last thing you have to think about is off-price, because there certainly is a challenging environment for lower-income consumers, and they're turning their attention to companies like TJX. We don't own that in the ETF. We do own Ross stores. And then lastly, you go nuanced. And if you want to go nuanced, there's Deckers. You're talking about the Hoka brand, which could be a $2 billion brand over the coming years. And the international expansion with Europe and China is still at the early days.
Yeah, Joe, you mentioned TJX, by the way. I have a story on CNBC Pro, and that was one of the stocks that traders thought would do well if we saw a cooler or inline PCE, and that's what we saw. TJX shares up 1%. Today, we're going to start off with Martin. You can see the shares down about 0.5%. Even after JP Morgan upgrades it to overweight from neutral. Sarat, you own this one.
I do. It's a great company, aggregate company. When you get demand for building, whether it's roads, infrastructure, you're going to see a tailwind here. We like this company. It's up about 20% year to date, but I think there's a lot more upside.
All right, moving on. We're going to look at Datadog. Its price target raised to 175 from 156 at Bank of America. Joe, you own this one in the JOTI ETF.
Very strong momentum breakout here in the month of November. And again, it's back to a software name that has reawakened after being dormant for several years. Plenty of room for this to accelerate further to the upside. I like the positioning here, and I think the pullback gives you an opportunity to get in.
All right, Morgan Stanley also out with a biopharma look ahead for the month of December. The firm is going to reiterate its underweight rating on Bristol Myers, as well as its overweight rating on Eli Lilly. Let's start with Bristol Myers. Sarat, you own this one as well.
I do, and it's been a terrible performer, but I still like it. I think the portfolio Bristol is underappreciated. I think you've got the overhang of the potential RFK appointment. It's a cheap stock, good dividend for a value stock. I would keep it.
All right, Joe, I'm going to come over to you as well. You also own Lilly.
We do. I mean, Lilly has been certainly over the last several years the biotech in the healthcare industry. I mean, that's clearly what it is. It trades absolutely like a biotech. So when something trades like a volatility, you have to understand that you're going to incur a lot of volatility in the name. Investors need to know that. You have to position the size accordingly. But I still think the secular bullish trend remains intact.
All right, moving on. Last but certainly not least, we're looking at Disney, reiterated as a buy at Daiwa. Sarat, you own this one as well.
I do, and Frank, this is one that's been a true value stock. Finally, you are seeing some of the things they've been working on in terms of streaming. You've seen the movie business actually this for winter is going to do pretty well. I also think the catalyst there is going to be, a potential breakup at some point. You see what Comcast, your parent company, did. So I think there are some things to look forward to that could be good catalysts for Disney.
All right, Disney shares up almost 1.5% right now. Weiss, I also want to come over to you. You own Netflix. I just want to kind of get your take. Obviously, these two are big competitors in the streaming space.
Yeah, and the good news is there's room for both of them. Netflix is, look, it's a superstar in the group. It's nicely profitable. It's got the ability to spend on new content, and there's scarcity to the pure play there. So we see volatility as the stock approached $900. I think it went over it. But the fundamental is still strong, and I think you stay with it. And if it gets down low enough, which hopefully doesn't happen, I may add to it. But it's a pretty large position now. It's one of my largest positions, actually.
Did you watch Paul Tyson?
Yeah, I mean, that was more of a variety show than a fight. The undercard was actually pretty good. But, yeah, that was kind of disgraceful. That is super, counter.
Their ability to do live events, though, that'll be an interesting narrative for that stock going forward.
And it's just starting there. That's not how I would have tested it. But, yeah, I think they'll do a lot more live events.
I think, yeah. All right, moving on. And we are back with final trades on halftime. Joe, you're up first.
All right, so look, fundamentally, I know nothing about Bitcoin. I defer to Mike Novogratz and Anthony Scaramucci, but what stands out to me today is that the technology sector is down significantly and Bitcoin is pressing higher. I think you get your 100,000 print here in the next couple of days. Whether that's the top or not, I have no idea.
All right, Bitcoin up more than 5.5%. Your pick is Coinbase. Shannon, coming over to you.
Financials, if you think about the opportunity for deregulation, expanded loan growth, M&A, lot of tailwinds, despite the fact we've already seen some appreciation here. A lot of tailwinds for financials into 25.
Sarat.
I like Disney. We talked about it before. I think the streaming business, the parks business, the movie business, they're all firing on all cylinders.
Weiss?
Yeah, I was going to say Bitcoin, but Joe beat me too. Thanks for the support. Meta Platforms, look, it's sold off enough. Fundamentals are excellent. I think it's a good time to buy it.
All right, that does it for the halftime report.